If you don't like dealing with tenants but still want real estate cash flow, then check this out. Discover how REITs can turn your small savings into big passive income. No tenants, no headaches, just cash flow. Let me show you how. Please remember to like, subscribe, and comment for more Money Smart Basics videos. Stay until the end to receive a bonus tip. If you have any suggestions for financial literacy topics for our next video, please leave a comment. Ever wanted to invest in real estate but thought it was too complicated or expensive? The idea of buying property, dealing with tenants, and managing maintenance can be overwhelming. Not to mention the high costs involved can be a significant barrier for many potential investors. That's where REITs come in. They simplify the process and make real estate investment accessible to everyone. REIT stands for Real Estate Investment Trust. These are companies that pool together funds from multiple investors to purchase, manage, and sell income-generating real estate. Think of it like a mutual fund for real estate. Just as mutual funds allow you to invest in a diversified portfolio of stocks or bonds, REITs let you invest in a diversified portfolio of real estate properties. Basically, a REIT is a company that owns, operates, or finances income-producing real estate. This can include commercial properties like office buildings, shopping malls, and hotels, as well as residential properties like apartment complexes. They allow you to invest in large-scale properties like shopping malls or apartments without actually buying the whole thing yourself. This means you can benefit from the income generated by these properties without the need to manage them directly. Instead, you buy shares in the REIT, just like you would buy stock in a company. These shares are traded on major stock exchanges, making it easy to buy and sell them as needed. It's a way to add real estate to your investment portfolio without the hassle of being a landlord. You don't have to worry about finding tenants, collecting rent, or handling repairs and maintenance. REITs offer a way to participate in the real estate market and earn potential returns. They provide a steady income stream through dividends, which are typically paid out quarterly. They do this by distributing most of their profits back to shareholders as dividends. This makes REITs an attractive option for income-focused investors looking for regular payouts. There are different types of REITs to choose from, including equity REITs, which own and operate properties, mortgage REITs, which provide financing for income-producing real estate, and hybrid REITs, which combine both strategies. Investing in REITs offers several benefits, such as diversification, liquidity, and professional management. By including REITs in your portfolio, you can spread your risk across different properties and markets. Additionally, REITs can provide long-term growth potential as the value of the underlying properties appreciates over time. This makes them a valuable addition to any investment strategy. So, if you're looking to invest in real estate without the complexities and high costs, consider adding REITs to your investment portfolio. They offer a simple, effective way to gain exposure to the real estate market and enjoy potential returns. So how do you actually invest in a REIT? It's pretty straightforward. REITs are publicly traded on major stock exchanges, just like regular companies. You can buy and sell shares of REITs through a brokerage account. It's the same process as buying or selling stocks. Each share represents a small ownership stake in the REIT and its underlying real estate assets. When you buy shares, you're essentially becoming a part owner of those properties. The value of your shares can go up or down depending on factors like the real estate market and the performance of the REIT itself. One of the biggest draws of REITs is their dividend income. Remember, REITs are required by law to distribute a significant portion of their taxable income to shareholders. This means that as a REIT shareholder, you're entitled to receive regular dividend payments. These dividends are typically paid out quarterly. The amount you receive depends on how many shares you own and the REIT's dividend policy. It's a way to earn passive income from your real estate investments. REITs don't just invest in any real estate. They are highly specialized and focus on specific types of properties to maximize their returns and manage risks effectively. They specialize in specific types of properties. Some common categories include retail, residential, office, healthcare, and industrial properties. Each category has its own unique characteristics and revenue models. Retail REITs. These REITs own and operate shopping centers, malls, and other retail spaces. They are crucial for providing the physical locations where businesses can sell their products and services to consumers. They make money from rent paid by retail businesses. The success of these REITs often depends on the economic health of the retail sector and consumer spending habits. Residential REITs. These REITs focus on residential properties like apartment buildings, student housing, and single-family homes. They play a vital role in providing housing solutions for various demographics. They generate income from rental payments. The demand for residential properties is often influenced by factors such as population growth, urbanization, and economic conditions. Office REITs. As the name suggests, these REITs own and manage office buildings. They provide the necessary infrastructure for businesses to operate efficiently. Their revenue comes from office space rentals. The performance of office REITs is closely tied to the job market and the demand for office space, which can fluctuate with economic cycles. Healthcare REITs. These REITs invest in healthcare-related properties like hospitals, medical office buildings, and senior living facilities. They are essential for supporting the healthcare infrastructure. They generate income from leasing these specialized properties to healthcare providers. The demand for healthcare REITs is often driven by the aging population and advancements in medical technology. Industrial REITs. These REITs own warehouses, distribution centers, and other industrial properties. They are integral to the supply chain and logistics sectors. They profit from the increasing demand for e-commerce and logistics space. The growth of online shopping and global trade has significantly boosted the demand for industrial properties. Understanding the different types of REITs and their specialized focus can help investors make informed decisions. Each type of REIT offers unique opportunities and challenges, making it essential to consider one's investment goals and risk tolerance. Section 5. Liquid assets. Buying and selling REITs. One major advantage of REITs is their liquidity. Since they're publicly traded, you can buy or sell your shares relatively easily during market hours. This is different from owning physical real estate, which can be illiquid and take time to sell. With REITs, you have the flexibility to adjust your investment as needed. However, it's important to remember that REIT prices can fluctuate just like any other stock. Market conditions can impact their value in the short term. Section 6. Different flavors of REITs: equity, mortgage, and hybrid. There are three main types of REITs, each with its own investment strategy. Equity REITs. These are the most common type. They own and operate income-producing real estate properties. Their profits come from rent and property appreciation. Mortgage REITs. Instead of owning properties directly, mortgage REITs provide financing to real estate investors. They make money from the interest earned on these loans. Hybrid REITs. These REITs use a combination of both equity and mortgage strategies. They might own some properties and also provide financing for others. Understanding the differences between these types is crucial for making informed investment decisions. Section 7. The perks of REIT investing. Investing in REITs offers several potential benefits that can enhance your financial portfolio and provide peace of mind. One of the most attractive features is passive income. REIT dividends provide a steady stream of passive income, which can supplement your regular earnings or help you achieve your financial goals. This consistent income can be particularly beneficial during retirement or periods of economic uncertainty. Another key benefit is diversification. REITs can help diversify your investment portfolio beyond traditional stocks and bonds. By including real estate in your investments, you can reduce risk and increase potential returns. Real estate often behaves differently than other asset classes, providing a buffer against market volatility. Real estate often behaves differently than other asset classes, offering a unique opportunity to balance your portfolio. This can be especially useful during market downturns when other investments may be underperforming. Accessibility is another significant advantage. REITs make it easy for anyone to invest in real estate, even with limited capital. You don't need to buy entire properties to get started. This opens up real estate investment to a broader audience, allowing more people to benefit from the potential gains. You don't need to buy entire properties to get started. This means you can start small and gradually increase your investment as you become more comfortable and knowledgeable about the market. Lastly, professional management is a major perk. When you invest in a REIT, you're benefiting from the expertise of professional real estate managers who handle the day-to-day operations of the properties. This includes everything from maintenance and tenant relations to financial management and strategic planning. Their expertise can lead to better property performance and, ultimately, higher returns for investors. By leveraging their skills and experience, you can enjoy the benefits of real estate investment without the hassle of managing properties yourself. This makes REITs an attractive option for both novice and experienced investors looking to diversify their portfolios and achieve financial stability. Section 8. Understanding the risks of REITs. While REITs offer potential advantages, it's important to be aware of the risks. Market risk REIT prices can fluctuate along with the broader real estate market. Economic downturns or changes in interest rates can impact REIT values. Interest rate risk. REITs can be sensitive to interest rate changes. When interest rates rise, borrowing costs for REITs increase, which can affect their profitability. Sector-specific risks. Different types of REITs face unique risks. For example, retail REITs might be affected by changes in consumer spending habits, while office REITs could be impacted by remote work trends. Section 9. REITs, a valuable addition to your portfolio. REITs can be a valuable addition to a well-diversified investment portfolio, offering potential for passive income, diversification, and long-term growth. By understanding how REITs work, the different types available, and the potential benefits and risks involved, you can make more informed decisions about whether REITs align with your investment goals. As with any investment, it's essential to do your own research, consider your risk tolerance, and consult with a financial advisor before making any investment decisions. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promised. You won't believe how much REITs have grown in just 10 years. That's right. Real estate investment trusts are crushing it. Ready to boost your portfolio? What's your favorite REIT strategy? Comment below. If you enjoy this video, click on the playlist in the box for more Money Smart Basics real estate market tips. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like, subscribe, and comment for more Money Smart Basics videos.